Thank you all for coming today. My name is Deborah James, and I'm the director of the International Program at the Center for Economic and Policy Research. We're very glad to be able to continue what has become now almost a series of exchanges with leading staff people from the International Monetary Fund to have a series of events where we can discuss policies that are currently being implemented and have an open discussion in the public with all of you, because we feel that it enriches the public debate to be able to have more open discussion person to person. So today we're going to be talking about the Eurozone recession and whether or not there are alternatives. We will first be joined by Mark Weisbrot, who is the co-founder and economist from the Center for Economic and Policy Research here in DC. And then we will have Mahmoud Pradhan, who is the Deputy Director of the European Department at the International Monetary Fund. And before we continue, I just want to thank my colleague Sarah for all of the support for getting this event on the ground, and also to Carla Shaman and Jeremy Mark from the IMF liaison for helping to make this happen. So this panel is going to focus on the role of debt, fiscal policy, and the European Central Bank in the current European recession. And we'd like each of our panelists to speak, and then they will also have a time to give comments about each other's talk, and we will enjoy all of you to ask questions at that time. And we're going to ask them to focus on a couple of different questions. The first is the worst over? Or where is this going right now? The second will be, are the economies of the Eurozone being held back by the need for structural reform or by macroeconomic policies? And finally, whether or not the European Central Bank could play a role more like the Federal Reserve in the United States, and would this help resolve the crisis? So these are just some of the questions we'll be answering today. So without further ado, Mark Weisbrot.
Thanks, Deborah. And is there a PowerPoint thing to move the slide? Oh, I get to go up there. That's fine. Thank you. Let's try that again. Okay, thanks everybody for coming. And I want to thank the IMF too for participating and having these events. I'm getting a sense of deja vu. I did this last year at the same place, and I think approximately the same time. And it kind of reminds me of that blogger who said recently, I forget his name, that he looks forward to writing about the Greek crisis until he's well into his 80s. So unfortunately, things haven't changed much since the last one. And I'm going to argue that it's because the policies are wrong. That is, it's not a debt crisis, really. It's a policy crisis, or a crisis of bad policy. And I guess I should make my usual disclaimer, since the IMF is good enough to participate. I should say, even though that these are IMF agreements that we're referring to, and the IMF is part of the three authorities often referred to as the Troika, that is responsible for policy in the weaker Eurozone economies right now, especially those with agreements, Greece and Ireland and Portugal, but it's also involved in Spain and Italy as well. I think that I should say that it really isn't the IMF's decision-making that is the main decision-making here. It really is the European authorities, and especially the European Central Bank, because the fund has a board of directors, and the Europeans are the ones really making, European authorities are the ones really calling the shots here. So, that said, let's start with Greece, because I think that's the most striking example of how bad policy has caused a terrible crisis. In 2010 and 2011, Greece took measures to cut spending by 8.7% of GDP. Now, for those who don't have a good idea or how much that is, or they're used to the U.S. economy, for example, that would be like getting rid of the whole federal budget deficit in 2 years, $1.3 trillion. And if anybody has any doubt about what this economy would look like if you did that, well, it would be probably even worse than Greece. And so, of course, as the economy shrinks, it's harder to make the revenue targets because you have this problem of the dog chasing its tail. Revenue falls as the economy shrinks, and so it's harder for them to reduce the fiscal deficit. And that's why the GDP ratio has been increasing drastically since these programs started. The IMF program started, I think, in May. The first agreement was signed in May of 2010. And you can see the IMF projections have been way off. And again, I guess I should let the IMF, give the IMF a break here too, because basically they have to make projections that make the numbers work out. And so probably there are economists there who know that these projections are not going to materialize, but they have to put something down on paper. In other words, they're shrinking the economy, but they're not going to acknowledge that, at least a priori. And so you can see the projections for output were off, have been lowered already from the first review to the fifth review by 6.9%, which is quite huge. And so that's most of that has come really in the 6 months, 5 or 6 months between the fourth and the fifth review, which was December of 2011. The same thing happened with unemployment. Again, it turns out much worse than they expected. It's now over 20%, and it was 14.5 was the projection in the first review. And the losses are enormous. I mean, this is almost 16% of GDP. If you look at the past 20 years, or even going back much further, financial crises, this is pretty bad by comparison. November unemployment 20.9%, and the projections for actually I don't have the latest April data for this, but I have it for the other. But 17% by 2016. I think it's at least that by 2017 in the latest projections. So not going to recover anytime soon. And then there's these measures that they agreed to take in the last debt restructuring agreement a couple of months ago. Cut the minimum wage by 20%, 32% for those under 25, and of course the mass layoffs in the public sector, 150,000 workers reduced by 2015, cuts to health and education. And here's a little bit about the human cost, because these numbers may seem abstract. This is from the British Medical Journal, The Lancet. This is the human cost of the entire recession, which is now it's in fifth year. But these numbers only go to 2009, and so because there's a lag, most of it, except for the last one, the 52% increase in HIV/AIDS from 2010 to 2011. But you can see increases in suicides, 17%, or maybe 25% from 2009 to 2010, and big increases in violence. Homicide and theft nearly doubling between 2007 and 2009. And so you see news reports of hospitals running short on medicine. And so these are some of the human and social costs. Of course, unemployment by itself is devastating for many people. And that is the biggest thing. In fact, you'll see in a little bit, when we look at the unemployment rates, the youth unemployment rate is now around 50%. And here you could also look at employment, which I think is in some sense a better measure, because a lot of people leave the country. And so this is saying, how many jobs are there, and it's lower than in 1994. And so what is the economic strategy? Is there a method to this madness? Well, the strategy is called internal devaluation. You can see references to this in the IMF reviews. So it isn't my theory. And basically, the theory is, the theory on which these policies are based, is that you can't do anything with your fiscal policy. That's going in the wrong direction, right? They're definitely making things worse by tightening the budget. The monetary policy is not under control because that's the European Central Bank. And of course, you can't change the nominal exchange rate because they have the euro. So all that's left is to try to change the real exchange rate, and that you do by creating so much unemployment that you push down wages to the point where the economy becomes more competitive internationally on the basis of lower labor costs. And you can see that it didn't really happen still. There's two different ways of measuring the real effective exchange rate, one using the consumer price index and the other using unit labor cost. And you do see some drop, it's not huge, by unit labor cost, no drop by CPI, but either way they're both still, the real exchange rate is still higher than it was in 2006. And part of it is that even when you do knock down wages and do all these other things, you know, the fluctuations in the euro, that's what happened in 2011. There was some progress in moving the real exchange rate down, and it was just swamped by the appreciation of the euro. So this is a problem when you don't have control over those policies. Now the debt, of course, these are different scenarios. I won't go into a lot of this, but basically, you know, the idea in the IMF fifth review and then even in the debt restructuring agreement, the goal is to get the debt down to 120% of GDP by 2020, which is still a high debt, but it could be manageable with relatively low interest rates. And the problem is that there was a leaked document, IMF document prepared for the finance ministers that came out right after the restructuring agreement, and that showed a more pessimistic scenario where if things didn't go as well as they thought, the debt would actually be 160% of GDP in 2020. And so, you know, that really wouldn't come to pass. What would happen is there would be another default before that because the interest burden would get so high as the debt grew and the markets would react. And so that's basically a forecast of another restructuring or maybe a chaotic default. And so is that scenario likely? I would say given what happened so far and given how far off the projections have been, you know, in being over-optimistic, I think the more pessimistic scenario for Greece is probably closer to what will happen. I think there's a good probability that Greece ends up with either another restructuring or just a default and even exit from the euro. And here you can see Greece's interest burden. I want to talk about this again. This is the most important measure. You know, the debt to GDP ratio is not the most important measure really because, you know, Japan has a debt to GDP ratio of 220% and it's still borrowing for 10-year bonds at 1% interest. And so what really matters most is the interest burden. And that's why Greece is struggling. They've got a 6.8, you can see there, that's all the way on the left, 6.8% of GDP they're spending on interest. You know, for the United States, net interest is about 1.7 now. And you can see, and we're supposed to have a huge debt problem too, we got downgraded not too long ago. And that shows you how, should I say, out of touch with reality the whole debate is in the United States over the debt. But that's a different story. But anyway, you can see that Greece is the highest in, nobody's even above 4% except Italy and Portugal. Now, this restructuring will lower the Greek debt burden, but only for a year. It gets down to 4.9, and then it goes up into the 6s again. And that was according to the last document we had associated with the restructuring. And of course, that's assuming again that things go relatively well. Okay, now are there alternatives? Well, the main alternative would be for the European Central Bank to do what the Federal Reserve has done here. You know, our central bank, which is headed by a Republican, you know, has created $2.3 trillion since 2008, and used that, a lot of that, to actually buy U.S. treasuries and other and the mortgage-backed securities as well. But it has the ability and has used it to push down long-term interest rates in the United States. And the ECB can do the same thing and has done so. You know, last year, towards the end of the year, when there was a crisis and the yield on Italian bonds went up to 7.8, 7.9%, and there was panic, the ECB did step in and started buying those bonds, and that automatically pushes down the yield. And so you see, that is the crisis. The ECB could end the crisis next week if they wanted to, simply by being willing to do that. They could set the overall crisis. There's two different things we're really talking about. One is the case of the individual countries, and I'm looking at Greece. The other is the crisis in the Eurozone, where you've had financial crises because of the threat of a Lehman Brothers type of meltdown. And that crisis has receded some for now, partly because of the ECB's decision to lend about $1 trillion to the private banks at 1% for a 3-year term. They used some of that to buy the bonds. But it didn't really end the crisis. You can see in the last week or so we've had, again, problems in Spain with their yield rising. And so you have this overall crisis which is hurting all of Europe. And I should say and emphasize, because not everybody here just cares about Europe, you know, Europe at least is fairly rich compared to most of the rest of the world. It also has lowered growth in the whole world economy. And the World Economic Outlook has a regional, a nice map of the region. The latest one, you can see how much another euro crisis, by their projection, would lower growth all over the world, from Russia to Africa to the Middle East and Asia. And even in the Americas, it's a little less, but it's still probably significant. And so you see, this is the main problem, is that the European Central Bank and the European authorities are not willing to engage in the policy that they can do, that they can actually do without even any cost to the taxpayer, by the way. It doesn't cost anything. You know, the money that Bernanke created here and bought the U.S. Treasuries, the interest on that goes right back to Treasury, so it's no increase in the net debt of the United States. And that's exactly what the ECB can do, but they won't do it. Okay? Why? Well, you know, that's a sociological question. But, you know, I would argue that one big reason, obviously there are political reasons, but I think those are exaggerated. The ones you see in most in the press, they're true to a certain extent. You know, you have the German fear of hyperinflation of 80 years ago. You have politicians playing upon that, politicians in the northern countries playing upon racist stereotypes of Greeks and Italians and whoever else. And, you know, all that stuff is real, but I still would argue that if the European authorities wanted to do this and they presented it to the public, you know, which would you rather have? We do like the Federal Reserve does, and you start, the economy recovers from recession and we start creating jobs, or we stick with current policy. I think the public would go along with it, and they would especially go along with it once they did it. Now, the other side of the argument, and you will find people right here in this building who will argue that even what the Fed has done will eventually create some terrible inflation. But of course, it hasn't happened in the United States. I think the latest CPI was 2.6 or 2.7 year over year. And if you look at the, actually I think I'll have that here pretty soon. But if you look at the latest numbers in the WIO, the projection for European inflation, it's projected to fall from 2.7 last year, 2.0 this year, to 1.6 next year. So there's no real threat of inflation. The ECB can, in fact, do what the Federal Reserve does, and then they could resolve the Greek crisis, of course, as well by loaning to them at low rates, as they have done for the banks, and so that they would not have this problem where their back keeps getting pushed to the wall because of the high interest burden. That's really the ultimate variable. Okay, so I wanted to emphasize that because that's the key problem here, in my opinion. Now, what should Greece or any other country do if the European authorities will not cooperate? Because you have them, you know, not recovering, well, they're not going to recover their pre-crisis level of GDP for 9 years. And again, projections have turned out to be a lot over-optimistic. So I want to look at the options because this is another alternative, given that the ECB does not seem likely to cooperate, although I have to say it is changing. Okay, I think there's a difference between, for instance, Draghi and his predecessor in their willingness to try and avoid the near-death experiences that they had last year. Okay, so I'm not completely hopeless, without hope on that. But given that they're not moving very fast in this direction, and they're still expecting another 2.8% of GDP of fiscal tightening in Greece this year, and then they said we want more spending cuts for 2013 and 2014. They backed off the spending cuts for this year because, I would say, because of the riots in the streets and the enormous political pressure. You now have the question of should they just default and exit the euro. Now, here's why I want to say that it's very important that people have an understanding of what actually happened in Argentina, because in the press, you know, when this subject comes up, because Argentina, you know, had a very successful default and devaluation. But when this subject comes up, the general discussion is framed as Greece can't do anything like what Argentina did. And that's because, and I think that the people who are, that could turn out to be true, you know, for instance, if you have an incompetent government, or a government that doesn't have enough courage to do what it needs to do, you could have a failure there. But the story about Argentina is really a wrong story. So their banking system did collapse when they defaulted at the end of 2001, and they devalued a few weeks later in January of 2002. But, and so they had a very bad decline in GDP for 1 quarter. It was 4.9%. And then they grew. They grew 63% over the next 6 years, real GDP growth. And of course, as I said, they recovered their, or maybe I didn't say it yet, they recovered their pre-crisis GDP in just 3 years, as opposed to the 9 or 10 years that Greece is projected to take in this scenario. And they had big increases in the social spending over the last 9 years, has tripled in real terms, and poverty has been reduced by 2/3. And by the way, I'm using the independent estimates of inflation here, not the official ones, which the IMF still accepts, but are widely believed to be too low. So even with these measures, this was a very, even using a much higher rate of inflation to adjust, this was an enormous success story. And here you can see it on a graph. Argentina reached its trend level of GDP within 7 years. That is just, you know, what they would have had if they had just been growing at the long-term trend. And you can see Greece is never projected to come up to its trend level of GDP. So it's a long-term decline and a very, very slow recovery if it happens. And a couple of just quick points about the Argentine recovery. It wasn't a commodities boom. In fact, it wasn't even export-led growth. Those 6 years that I told you about from 2002 to 2008 was not led by exports. It was led by domestic consumption and investment. Exports contributed about 12% to the growth that happened. 12% of the growth that happened was due to exports, and maybe half of that was due to commodities. So that's a myth, and in fact, the big thing was that once they devalued and defaulted, they were able to change their macroeconomic policy, which I won't go into, to a set of policies that was pro-growth, unlike Greece and the other countries that are stuck in recession and are not able to do that. And Greece actually has a much bigger export sector than Argentina. It's about twice the size relative to GDP. They have more places they can borrow from today. In fact, Argentina didn't have anybody. They actually had money being drained out of the country by the official lenders during the worst of the crisis. And they have a more developed economy. So I think that they probably would be better off leaving. But again, that's a tough decision. And I wouldn't, just advise the government to do that. I would say that it has to be considered when you're not being left. You've got 20% unemployment, and there's still no light at the end of the tunnel here. Okay, so that would be my argument. Now, taking a look at the Eurozone a little bit more in general, this is from the latest outlook, and it says, as you can see, a renewed escalation of the euro crisis remains a possibility so long as the underlying issues are not resolved. Now, of course, the underlying issues, that really depends on your perspective. If you have an orthodox perspective, the underlying problem is the debt and also, inefficiencies in the economy that they're trying to resolve. And I guess that is the other part of the why question that I didn't answer and should. Why does the ECB not just put an end to the euro crisis and an end to this downside risk, which is the big one, the one that really slowed world economic growth for this year by something like $800 billion. Okay, why don't they put an end to that? And I would say that if you look at the statements in the press, and it doesn't really take much reading between the lines, you can see that they feel, and the European authorities feel, that if they were to do that, that they would not get the structural changes in these economies, the raising the retirement age, cutting the minimum wage, the cutting the size of government. And Greece's 2020 is going to have a budget more like the size, a government more like the size of the U.S. than a European government. Those are the big changes they want to make, and those are changes that Europeans would never vote for. And so that's why they need, I think, not to put an end to the crisis, but again, it's a balancing act because they also don't want to see a meltdown. That's what I would say to that. And now you can see the numbers from the latest wheel, probably too small to see, but the only ones I wanted to point out where you have a recession for 2012 in the euro area, for the whole area, of the economy shrinking by 0.3%. And then, again, the inflation numbers I already mentioned, they're right there for 2010, 11, 12, and 13. So that was the main thing I wanted to call attention to. These are quarterly growth rates, and you can see the decline. Even Germany, this only goes through the end of 2011, but it's pretty much across the board. Even the Netherlands, one of the most fiscally conservative of the governments. Ireland, we thought they were recovering for a while, and no, it turned out not to be true. Portugal doing quite badly. And Italy now, this was really, I think, a result of the fiscal tightening and, of course, the Eurozone crisis. They were doing okay until the last quarter of 2003. And they still have the lowest unemployment rate of the so-called PIGS country. Spain, of course, slipping back into recession with 24% unemployment. Here you can see the unemployment rates that I already mentioned. And in Greece, Ireland, about 14.5. Not coming down too fast, still very high compared to pre-crisis levels. Portugal, Spain, the worst. And again, you can see also this change in the real effective exchange rate for all of Europe. nobody's really got much of an internal devaluation going on. With Greece rising, these are by both measures, the CPI and the unit labor cost measure. You've got the most in Ireland, but it's still not huge. I mean, 5%. That isn't going to be enough to pull you out of a recession through exports. Here's a good one, because you can see that's the effect of the Spanish government, according to the Spanish government itself. That's the effect of the planned spending cuts in Spain that they're planning now. It will cut, that block there shows you that it will cut about 2.3 percentage points out of GDP growth if they are actually implemented. I think the best hope we have is that these things are not implemented, because there's a lot of resistance to them. There's the youth unemployment over 50% around 50% in Greece and Spain. And again, the net interest burden, I wanted to remind, that was, I already explained that, but I think that's the key thing. That's what the ECB could do. And here's just a little preview of the fiscal tightening that's been committed to. So here's, or has been done. There's Ireland. You can see what pushed them back into the hole. Big spending cuts. Sarkozy has, if he wins, but actually the Socialist Party candidate has made the same pledge, almost the same pledge. They want to balance the budget by 2017, Hollande, and 2016 for Sarkozy. Now, it may be that they won't do that, especially if the Socialist candidate wins. Probably they won't do it in any case. But again, if they actually follow the policy that they're committing to, you can expect further shrinkage and more unemployment in France as well. And here's Spain committed to pretty sizable cuts, 2.3% of GDP. That's enough to push the economy further into recession in this year. Again, I can only hope they won't do it. So here's the conclusion, and I'm going to quit. You've all been very patient and stayed awake through the entire thing, which I think is very impressive. And so here is, I think, obviously, it's not a debt crisis. It is a crisis of bad policy. It's had a terrible effect on the world economy, and we have alternatives, but they're not. The ECB and the European authorities are not willing to use them. And on that basis, I would say that any country that, any responsible government that is looking out for the welfare of its people, and especially employment, which is the thing that matters most, they really should consider other options, including default and exit. Okay, thank you very much.
Can I speak from here? Can you hear me?
Yes.
Yeah. If you don't mind, I'll speak from here, because I don't have a prepared PowerPoint, but I'm very happy that you've given us a lot of material to think about, and I think what might be useful, if I can give some comments on what Mark is talking about, and then maybe we can have an exchange. I feel like I could really cut my comments really short and say that when I meet some colleagues from the ECB later this weekend, I could tell them that they could end the crisis next week. And, that would probably be the most helpful.
That'd be great.
Thing you said.
Please pass it on.
I'm afraid I'm going to argue that I don't think it's that easy. Let me start by saying that I'm not going to speak very directly on Greece. I work at the IMF in the European department. I work on the euro area, and a lot of the issues that Mark has touched on, I work on those issues on the crisis, but not the specific country, Greece. I will make some remarks on what Mark has said about Greece. Let me start with the big themes, and I'll go into some details that Mark is talking about. I'll use Greece as an example, but I want to develop it a little bit further. Some of the things you did not tell us, Mark, about Greece, I think are relevant. One, that if Greece defaulted and exited the euro, Greece still runs a primary deficit. Okay. What does that mean? It means Greece is not even if it had no, let's say, it wiped out its debt through a default. It runs a primary deficit. That means the Greek government needs to borrow money every year still to finance its expenditures, part of its expenditures, not the entire lot. I.e., its expenditures are above what it collects in tax revenue, etc. Okay. I think there may be many other differences with Argentina. I don't want to dwell with that, but that's a really big one that you should give some thought to. Okay. How does it finance the rest of it? But before I go into a little bit more detail, let's think about the following. What is this troika trying to do? Okay. It's trying to help countries through an adjustment process. So we need to understand what is that adjustment process. Okay. So very simply, the IMF together with the European partners are providing countries that are supporting these adjustment programs, Greece, Ireland, Portugal, okay, with finance at a reasonable cost. And by that we mean at a cost which is much less than what these countries currently pay in the market. Okay. I think that's fundamentally something you should not forget. That's really what we're doing. Okay. The alternative, you explore one set of alternatives, which is debt default and exits. Maybe I'm simplifying that a little bit, but that's what the alternative right now for these countries is to borrow at market rates, if possible. Some of these countries don't have access to market financing, meaning the markets won't lend at any price. Okay? Some of these countries do have access to markets, but at very, very high cost. When you borrow at a very high cost, it makes that adjustment very, very difficult, or more difficult. That's really the underlying rationale. Now, you're very right, Mark, to say, let's have a discussion about what are the policies that are going to get you through this adjustment? What are the policies that are going to help you adjust? I mean, we should be having that discussion as wide as possible. And I can assure you that we do. We consult very, very widely. But let me just start with that kind of initial point. That's what we're doing. Meaning the financing is not available for these countries. In Greece, if it's running a primary deficit, it needs financing. Okay? And no one's going to help to finance it. What am I saying? I'm saying you are putting forward an argument that this austerity is too tough for Greece. Without a troika program, that austerity would be tougher. That's really what I'm saying. Okay? And I think we need to be clear about that. That austerity would be tougher because they would not have the official financing that they have. Let me, while I'm touching on Greece, I want to kind of start with Greece, but just broaden the issue. You point to a lot of things that I think are very relevant, meaning real exchange rate adjustment. Let's think about what you're really referring to. We want these economies in some way to, let's say, using your argument about Argentina or Greece or the chart you showed on Ireland, we want some of these economies have been through a period where they were not competitive, a very long period. They need to somehow regain competitiveness. Okay, there are various ways of doing it. In particular, let me point to just as a minor example, you worry and you raise the question about Greece's real exchange rate adjustment. We haven't seen enough. What I thought was much more interesting on your chart on Greece's real exchange rate is the trend appreciation of the real exchange rate through the 2000s. That's what the problem was. That's what we're trying to address. You are right to say we would prefer Greece to adjust faster, its real exchange rate, Greece to regain competitiveness, and whichever way we do it. And we are worried about that, and that's a relevant question to ask, but why are we here? And that's a much more important question, which is the underlying rationale for why we need to adjust. While we're on Greece, let me just say very quickly, you offer a comparison with Japan. You point to Greece having a very high interest burden, okay, and you put it in percent of GDP, and You give a very relevant example that Japan has a much, much higher debt burden in terms of percentage of GDP, but pays 1% interest. Isn't that the puzzle we should be asking? Why does Japan access markets at 1% interest rate? Okay? Why doesn't Greece? Or some of the other countries that we're talking about here? These are not, Japan, Greece interest rates are not imposed on by any official. Okay? They are what the world wants to lend Japan money at, or what the world wants to lend Greece money at. Japan has probably the largest net foreign assets in the world. Japan has run current account surpluses for a very, very long time. Okay? Japan has a very large bond market, of which only 5%, okay, 5% of Japanese bonds are held by foreigners. 95% of Japan's bonds are held by local Japanese residents, so Japanese savings, their finance, right? We are dealing with a very, very different situation in Greece. Greece cannot raise money domestically. And I come back to my point, that's why default is not an option. You are still running a deficit. Where are you going to borrow that money from? Okay? Now, I want you to sort of think about that argument a little bit more, because because Mark has been talking about Greece, I think it's fair to just make some comments on Greece, but just think a little bit more about what is the adjustment going on in Europe in a wider level. Okay? And I'll use Spain as an example here. Okay? Spanish unemployment in 1992, okay, before Spain joined the euro, was 23%. Okay? Spain went through a period after joining the euro of benefiting from the following: convergence in interest rates. Spanish households and Spanish governments and Spanish corporates could borrow at very, very low rates, very close to rates that prevailed for German borrowers. Okay? And this is a phenomenon that happened throughout Europe. This led to very large borrowing in a number of countries. We're now facing where, if I just give you one statistic, okay, the debt of the corporate sector in Spain is about twice as large as the debt of the corporate sector in the US. Okay. This was incurred when borrowing rates were very favorable. Now, they're not favorable, okay, because the debt burdens have become very large, and now we're going through the adjustment process. Right? And I just want to say this adjustment is not as simple as the ECB coming and ending the crisis next week and buying the debt of Spain, of Italy, etc. We look at government debt statistics. If you look at Spain, Portugal, the debt of the private sector is larger, and significantly larger than the debt of the government. Okay? It's not just about the ECB buying government debt. Okay? You pointed to an example, and I'm not against this at all, by the way, but I just want to point out something. When the ECB got into something similar that you praised the Fed for and other central banks for, buying government debt in Spain and Italy and reduced yields, we did not observe borrowing costs of the Italian private sector or the Spanish private sector fall. Okay? That's telling you that there's an underlying problem, which is just something that the ECB cannot on its own address. And I do not want to claim that the ECB does not have a very big part to play, a very constructive role to play in addressing the crisis. I would want to agree with you on that. One of the examples that, again, I'm not going to dwell on this too much because I started out saying I do not want to talk too much about specific countries, but I want to make a broader point. I had a meeting this morning, and I'm going to give you some statistics, just that happen to be important, an interesting comparison, with the delegation that is visiting these meetings from Latvia. Okay. And I'll tell you why I want to mention Latvia. Latvia has an exchange rate which is pegged to the euro, but it is not part of the euro. Okay? It is not part of the Eurozone. Okay? In our meetings this morning, their discussions with us were about their desire to join the Eurozone. Okay? Now, we are sitting here talking about the crisis in the Eurozone, and I just want to point out that there are countries that want to become members of this Eurozone. And I think, I'll come back to some other minor points on Latvia. The reason I raise Latvia is because they have gone through a similar program of adjustment. They're almost graduating to an exit strategy very soon. Very, very large adjustment with a pegged exchange rate, no defaults, no exits from the peg. Okay? They have managed to reduce their debt to GDP ratio from 90% of GDP to 45% of GDP in the space of 3 years.
Some of that was inflation.
Okay, some of that was inflation. The peg survived.
Yeah.
Okay? I'm talking about in percentage of GDP, so it's not quite. There's a denominator as well. But anyway, they have reduced public sector wages by 25%. Right, and private sector wages fell by about 10%. Okay, they're now, this is not a very kind of comparable, the fastest growing economy in the EU. My point is more general, that here's a country that wants to join the euro. But I want to talk about what is the basis on which the IMF enters into adjustment programs. What are the things that, what are the conditions for programs, broadly speaking, working, right? They may take a little longer and so on. If we look at Greece, take the extreme example again, Greece, okay? Greece is about to go through some elections very shortly. Current opinion polls in Greece say 2/3 of the population want to stay in the euro. Okay? If you looked at Spain, which is also going through all the economic hardships you pointed to, that's the proportion of people who want to stay in the euro is even larger than that. Okay? We, at the IMF, we work with countries that have that instrument, a flexible exchange rate, and that then gets incorporated into programs. We work with countries that don't have that instrument of economic policy of changing their exchange rate. But if they choose to stay in the euro area, which is something they have been in for a while, and we will work in terms of our adjustment programs within the confines of that. We're kind of respecting that sovereignty, right? That's not a decision. But I want to hypothetically, and I emphasize here, hypothetically explore your point, Mark, which is the adjustment you describe in Greece is difficult, but other countries are going through, you mentioned Spain, other countries are going through very difficult adjustments and so on. What would happen if they decided that they wanted to exit the euro, right? You point to two benefits. One is they regain the exchange rate as a policy instrument. Argentina was, presumably that's what you were kind of illustrating with Argentina.
And they regain their fiscal and monetary policy.
But because of the exchange rate. Greece cannot have a fiscal expansion now, that's my point, unless you're claiming otherwise. Could Greece have a fiscal expansion?
I think with the devaluation, yeah, they would.
Well, that they regain because they regain that instrument.
Yeah.
Right.
Both fiscal and monetary.
Okay, I'll come back to that in a second. But let's say in the euro, there are huge, the euro area has existed for a while now. There are absolutely massive cross-border exposures. Okay? One country exiting and defaulting could create the biggest financial crisis we've ever seen. Okay? I think you really have to think about how large these exposures are between, say, Italian banks and German banks, Spanish banks and the rest of Europe. I pointed to, for example, Spanish private sector indebtedness being very, very high. A lot of that debt is to other countries within the euro area. Okay? You have to think of this issue not as one country can exit, default on its debt, and benefit in the way that you think Argentina has benefited. That's not an option for Europe. Okay? You really have to think about, could this be done? Okay? I think in the interest of time, I want to give more time. If I haven't addressed any specific points you raised, I'm happy to do that. But otherwise, let me stop here and ask, give time for questions or comments from the floor, or Mark, you may want to respond to.
Yeah, let me respond, because I think you raised a lot of interesting points.
By the way, one point that I forgot. Do you mind if I just say one?
Go right ahead.
I don't want to go into the technical details, but I just want to make one point about the ECB. The ECB's current size of its balance sheet is larger than the Fed. Okay? It chooses to do something in a slightly different way, but you're painting a misleading picture. You're saying the Fed has gone out and purchased all these assets, and the ECB has not done that. That's technically absolutely true. You're right. But the ECB, through its liquidity provision, has right now a larger balance sheet in terms of euro area GDP than the Fed and the Bank of Japan. Okay? So the ECB has chosen to play its role in a slightly different way, but it's misleading to say that it's not. You know, we can debate whether it should be purchasing more assets of Italian debt or Spanish debt or other countries' debt. I think we can get into that later, maybe when we have time. But I just wanted to make that. Sorry, thanks. I'll let you.
Okay, let me respond to that first before I forget it. Sure, they have a big balance sheet, but they haven't done what they needed to do, which is to put a floor, put a ceiling on the rates of the Italian and Spanish bonds in particular, because those are the countries that are too big to fail, and debt that's too big to fail. And that is the big threat. And so when I said they could end the crisis next week, I don't mean they're going to end every problem in Europe, but they could put an end to the problem that we saw last year that really did, that we both agree, I think, you know, took a huge amount of output and employment out of not only Europe, but the whole world economy, okay? That's the crisis they could end by just committing. They probably wouldn't even have to buy that much. If they committed, if they said, you know, Italian and Spanish bonds are not going to go over a certain interest rate, and then they did that, they intervened to do that, I think that would stick. And so that would put an end to that part of the crisis, the most acute and dangerous part. Now, the other stuff. First of all, there's two questions here I want to separate it, okay? One is, what could be done if the European authorities, including the European Central Bank, were really willing to do what was necessary? And then there's the second question, which you address when you say, you know, Greece still has a primary deficit, i.e. that's referring to Greece can't just, even if they default now, they still don't have money. Well, the European authorities should allow them to have a restructuring that lowers their debt burden enough so they're not going from crisis to crisis for the next 10 years. And so that's what they should do. Now the question, can they default and exit even though they can't make their budget right now without having to pay any interest, okay, to the foreign bondholders? And my answer would be, yeah, they could still do it, because first of all, there's a lot of countries in this world now that have collectively trillions of dollars of reserves. Greece is a small country. I think somebody would help them. You know, you've seen that in Latin America. You know, Venezuela loaned $6 billion to Argentina when they needed it, when they wanted to pay off, get rid of the IMF, for example. There's China has loaned money to a whole lot of countries, billions in Latin America. Would they do that for Greece? Somebody would do it. I think. I mean, obviously, you'd want to go. A good government would go and try and arrange that beforehand. But I think, yeah, they could do it. And the other thing is, as a matter of just straight macroeconomics, once they have their own currency, they don't have to finance their budget in euros anymore. they can also use their own currency. Now you can say, well, they're going to get hyperinflation, but they wouldn't necessarily get that. They could finance a certain amount of deficit through money creation. I don't think anybody can really deny that they could do it. The question would be how much before they would, have an inflationary impact. And so that's the hardest question of all, and I agree. And I don't think that's an easy decision for the Greek government. It's kind of like if you make a bad investment and you don't know when to quit, right? Because the economy might recover. You'd be taking a big risk. They'd be taking a big risk by doing it. Now, as to what it would do the rest of Europe, well, I'm sorry. If I'm the Greek government, I'm not going to worry about that because they're the ones that are screwing Greece, okay? And they're the ones that have forced them to adopt these measures. And so the Greek people shouldn't have to take the hit for all of Europe. If the Europeans don't want a financial crisis caused by a Greek default, then they can provide them a package which allows the economy to grow, okay? And if they're not going to do that, then why should Greece sacrifice and for Europe, okay, when they've got all the money in the world, and Greece is only 3% of the Eurozone's GDP. It's less than that now, actually. So, and that, I guess, addresses your argument of, like, if you didn't have the Troika program, austerity would be even tougher. Well, I don't know about that, because, again, that's what they said to Argentina, and it turned out not to be true at all, okay? Austerity was tough for 1 quarter after the default devaluation, and then austerity was gone, okay? And, again, you have to have a government willing to pursue the right policies. And yeah, they would, in terms of that big private sector debt, well, a lot of that would be defaulted upon. And the ECB would have to bail out the banks like we did here. I agree with you completely on the bubble growth of the 2000s, and that was the problem, okay? And that's where your foreign borrowing, private sector borrowing comes from. And I'm actually very glad you said that, because most of the world doesn't realize that the crisis in Europe is a crisis brought on by private sector rather than public sector borrowing, okay? Everybody should know that, and I'm glad you explained that to people, with the possible, of course, exception of Greece. The other country, it was private sector borrowing that caused the crisis, just as in the United States. There were bubbles, those collapsed, you had a world financial crisis. That led to the decline in revenue, and that gave you the public sector debt that you have now, same as in the United States. And we had an $8 trillion housing bubble here, okay? And that's what caused our recession. And are we still in recession? No, okay? Because our government didn't follow these kinds of policies. We had a stimulus, which was way too small, but it was still in the right direction. And we had the monetary policy of the Federal Reserve, okay? And instead of the ECB. So that is the difference. And again, everything you're saying is true. There was a problem of real exchange rate appreciation in the 2000s. There were all kinds of mistakes made. But the end result is, when all that happens, when the bubbles burst, the question is, what do you do about it? Do you make it worse, or do you actually try to get out of it like we did in the United States? And that is still, to me, the problem. Now, I want to just look at Latvia for a minute, because I just had this debate with Anders Aslund, who has been studying Latvia since the 70s and advising the government and everything else. And I think it's a very interesting case. I think that they made a huge mistake. I mean, they lost a quarter of their GDP. They had 10% of the people leave the country. Unemployment at the low, conservative measure hit 20%, 30% by, if you take the people who've given up looking for work and involuntarily part-time. These are huge social costs. And what are they going to grow this year? 2.5%. So this isn't exactly a fast rebound. This isn't an Argentine rebound, okay? And according to Aslund, and I have every reason to believe him from just reading the IMF documents, if you read between the lines, he claims that the IMF itself thought that it was a bad policy to keep the peg, that they should have devalued, which makes sense to me. They learned from their mistakes in Argentina, and so they thought also that the cost was too high for what they were going through. They would have had a faster recovery with a devaluation, which would have involved debt restructuring because you had all the, most of their borrowing was in euros and private sector borrowing in euros. But I think they suffered way too much, and we don't even know how long it's going to take them. And in terms of, and you're right, they want to join the euro. To me, that's a political decision. This is a very conservative, a right-wing government. They, for all kinds of reasons, political reasons, they want to be locked in to Europe in a certain way. Some of them are still fighting the Cold War. And so they're willing to pay any price in the world to do that. But to me, I mean, to join the euro, Poland just put it off, right? Because, it's a reasonable thing to think we want to wait for new management here. After you've got your second recession in less than 3 years, and it's not looking very good going forward. Maybe this isn't the monetary union. Maybe you want to keep control of not only your exchange rate, but your macroeconomic policy too. So I'll leave it there, and you get to have the last.
No, I'm happy with it.